We're all planning and preparing for the new year. Well, at least I hope that is the case. Now, we saw our fair share of challenges from drought to hurricanes, food shortages, and diesel supply scares to flooding and record high inflation. Not to mention job loss and a deep recession. Oh, yeah, and the threat of a railroad workers' strike, potentially shutting down a huge portion of the U.S. supply chain and possibly costing the U.S. economy some $2 billion per day. Well, we survived it. We made it, sort of. So you see, for those who managed to escape 2022 with the shirts still on their backs, 2023 is going to begin with an intense financial challenge for those that are ill prepared. This message is specifically for the low income, working class, and middle class, and those considered poor or in poverty. With MoneyWise.com stating a study by the Economic Policy Institute found that the average earnings of those in the top 10% were roughly $173,000 in 2020. So we know that this figure is much higher by today's standards, and this is a shift of wealth and a transfer of higher likelihoods of being unable to afford life's basic necessities, spilling over into the overall economic standstill of the economy. The growing consensus of data reveals that researchers say millions have lost a step into the middle class, and the new figure points to the challenge for the majority of Americans who do not have a 4-year college degree. And the American middle class is losing ground. No longer the majority and falling behind financially. The American middle class is at the end of an era. And the increase in corporate bankruptcies is bad news for workers and job seekers. And although retailers like Macy's, Dick's Sporting Goods, H&M, and Victoria's Secret are trying to offer shoppers new experiences, it isn't helping as malls see a tsunami of store closures and falling traffic, leading to even more store closures, with more layoffs spreading across corporate America. The shockwaves from the global financial crisis are now being felt in almost every corner of working America as companies press the eject button on an increasing number of employees, which is a direct motivating factor behind so many new members coming over and joining the network to find ways that they too can stabilize their income and plan and prepare for future financial security in these troubling times. Feel free to contact me. Links are in the description below. And now is no time better than ever, as the U.S. retail apocalypse is a slow motion disaster that never seems to end. While several brands spent decades building their businesses, attracting their base of customers, investing in real estate space, and perfecting their products to become respected household names, the advent of e-commerce changed the entire game in just a few years. And everything businesses thought they knew was put into question as they rushed to adapt to a new market that moved much faster and where shoppers had significantly more choices. The after effects of the financial crisis led to several waves of mass layoffs and store closings that left many companies standing on very thin ice. And the stock market volatility that followed ended the journey of many retailers that were on our landscape for over a century. In 2017, the period commonly known as the start of this whole process, over 9,000 stores were permanently shut down as foot traffic at shopping malls drastically declined. But the truth is that this crisis had been developing for nearly 15 years before the industry finally reached its breaking point. Since then, thousands of popular brands have filed for bankruptcy and have gone out of business. And for the first time in history, shopping malls actually face the threat of extinction. One thing all retail experts note is the fact that neither the rise of online shopping platforms nor the financial turbulence that marked this period can completely explain why just so many successful businesses failed almost overnight. One of the most notable trends driving the downfall of retailers is the steady decline of the U.S. middle class. Since the year of 2000, it is estimated that U.S. middle-class Americans lost 35% of their purchasing power, with 5% of that loss happening over the last 2 years alone. From that period to this day, almost 22 million workers have fallen out of the middle class, given that wages stagnated, but the cost of living has increased by almost 4.5 times only in the past decade. Of course, the advent of the pandemic caused even more damage to the retail industry and this income group as a whole. In fact, this holiday season is the first in nearly 14 years where businesses in all categories saw sales contracting instead of rising. The troubles faced by retailers were exposed and aggravated by the effects of the health crisis induced downturn. And after things started falling apart, one problem led to another and another and another, creating a downward spiral that companies are making this scenario even scarier for many businesses up until this day. With mass layoffs being announced on a weekly basis, businesses facing even tighter credit conditions than they've seen in decades, and consumers rolling back their spending amid rising living expenses, it's safe to say that a series of disappointing corporate earnings results is coming next. And with it, more announcements of store shutdowns and bankruptcy filings are likely to arise. A lot is at stake still, and we will watch many more developments in 2023 as we head towards another economic recession. But today, I decided to gather some even more surprising facts about the U.S. middle class apocalypse and low-income family wipeout that many of you out there may not know just yet. And so if you're watching this video right now and you are thinking to yourself, Kevin, we made it. We survived 2022 and avoided the economic collapse and personal family financial wipeout that the Fed's monetary policy plans had put in motion. And we're still employed and our businesses are still operational and may even be turning a profit. We made it. Well, folks, we mustn't look at this success and be confused or misled that it is a sign that we can let up or back off from continuing to prepare. From natural catastrophes and cyber attacks to retirement savings and health risks, more types of risks are becoming harder and harder to insure. The worsening of the protection gap is one of the biggest challenges insurers will need to address next year. And according to Isabel Sananak, global insurance leader for professional services giant Ernst & Young, inflation sits at the top of the insurance industry's list of current concerns. Insurers' appetite for volatility will be lower as they try to manage costlier claims. Many insurers and reinsurers are pulling capacity in some areas or sectors due to immense losses, which is also contributing to the lack of protection. Additionally, when the impacts of inflation are passed on to consumers as prices increase, affordability becomes a major concern. Like when comparing the difference a couple of years can make. Once flushed with additional savings from the pandemic, many consumers have exhausted that excess cash due to ongoing inflationary pressures and are now turning to credit cards to fund their holiday spending. This after the federal government sent stimulus checks to most Americans, what some would consider to be a windfall of cash and limited ways to spend it. Americans' personal savings rate, defined as the percentage of disposable after-tax personal income that is saved, hit a historic 33% in April of 2020. It remained elevated through late 2021, but now new data from the Bureau of Economic Analysis shows that the U.S. personal savings rate has plummeted and that it has now hit a new 17-year low. How quickly that has changed. More on that later in the video. And so, much like retailers that are making changes to avoid total extinction, these insurance carriers can adapt to both the economic uncertainty and complex and dynamic risk landscape by innovating as well. Unique challenges need unique solutions, and this is both a point of evolution and opportunity for the insurance industry. New ways of distributing insurance products, such as through partnerships or embedded insurance, will also challenge carriers to see their customers in a new light. And big tech companies like Amazon, which recently rattled the industry by launching its own insurance price comparison website in the UK, have the potential to create huge disruption. And clearly, most people are also reluctant to scale back their standard of living and haven't yet adjusted their budgets, so their first impulse is to borrow, bringing even further problems that are added and compounded into the mix. The instinct to borrow under these circumstances makes perfect sense, but it's unfortunate given that borrowing has gotten considerably more expensive due to rising interest rates pushed by the Fed. The average rate on a credit card is now 19.55% according to the latest bank rate data, the highest it's been. And at the start of the year, the average rate on a credit card was 16.3%, according to the same bank rate data. For someone making only minimum payments towards a $5,000 balance in credit card debt, the rate hikes have added 7 months to the payback cycle, costing an additional $1,166 in interest. And this is when the average APR is at 19.4%. At the same time, Americans are falling deeper into debt. Balances jumped 15% year over year in the third quarter. That's the largest annual increase in more than 20 years. Folks, we're back to pre-pandemic levels in terms of credit card balances, and those who are carrying balances are carrying them for a longer period of time. In fact, among Americans who carry credit card debt from month to month, 60% have been revolving this debt for at least a year. And this is according to creditcards.com. This is up from 50% last year. Lower income households are feeling the greatest strain. A greater percentage of those earning under $50,000 a year are struggling to make minimum payments, while banks are starting to take notice. They say, while we're seeing pockets of households struggling, especially at the subprime level, the big picture is still relatively positive. Delinquencies, defaults, and the average American's debt-to-income ratio are all below historical norms. Consumers generally are in pretty good shape. Comment down below if you agree. Now, the big wild card. What happens to the job market in 2023 as the Fed tries to put the lid on inflation? Unemployment will rise, but does it go up to 4.5%, 5%, or 6%? The hope is that if there is a recession, it will be mild. Meanwhile, those who've been laid off are finding new jobs relatively quickly, and the single biggest predictor as to whether or not someone is going to pay down their debt is whether or not they have a job. Now, this is all going to be dependent on your skill, market, resume, etc. Folks, coming up on the next videos, the plan of the FDA exposed. In less than 30 days, these folks could be wiped out. Heads up, we're being lied to. This is unbelievable. And I received a shocking email that tells me everything I needed to know. Until next time, you all take care and be safe.